going to get our overlay going. And yeah, we'll kick this off. I'm trying to shorten these introductions. Well, we had a lot happen in the world of crypto this week. The Doge dog passed away, right? That's the Shiba Inu dog that the mascot or the logo is based on, passed away. A couple videos circulated social media. One of them was Michael Saylor saying that every token except Bitcoin will be deemed a crypto asset security and that Bitcoin would be the only ETF approved. We know that's not true. The Ethereum ETF was approved at the end of last week. Another video, Charles Hoskinson. It's one of his older videos that we actually covered on the stream, I think back in November, December, where he says that the industry doesn't need Bitcoin anymore. Bitcoin, I guess to him is outdated and limiting. He's the Cardano guy. I wonder what he's telling his token holders that bought at $3 and the token's down 80%. Even though we're in a bull market, the crypto market cap is near all-time highs. So that was kind of an interesting video that circulated. Doesn't need Bitcoin. Who needs it, right? It's the only thing driving adoption right now, it seems. Traditional markets. Was looking at headlines all week. Markets are volatile. Biggest sell-off of the year. And then I look and the SPY and the Dow are basically at all-time highs. So don't know what the financial media is trying to tell us, but it seems like you're doing okay if you're a long-term investor, right? And like I said, we are in a bull market, and in crypto terms, price goes up. That's all that matters. But why isn't your portfolio going up? Why isn't mine? Why aren't all my tokens going up? That's kind of the thing that we explore here. We don't try to sell you a bunch of tokens and then dump them on your head. That's not what I do. In fact, I make sure that we take kind of a cautious approach, cautiously optimistic approach into crypto and understand some of the risks while also understanding that crypto in general, for every person that's in crypto, there is someone who has either gotten rich or gotten completely wrecked. And we try to stay in the middle, understand why both happen so we could position and learn about the industry appropriately. What this isn't is an investing channel. There's no financial advice given. Sure, I share some of my token buys and sells with you. A lot of the sources are not verified. And I have one risk tolerance. You may have another risk tolerance. Most people don't know what risk tolerance is, but this is not an investing or advice channel for your trades. You do your own research. My portfolio is my portfolio and yours is yours. Let's look at the markets. Like to look at the winners and losers for the last 7 days. Pepe is on a tear, up 75% in the last week. Bonk, so 2 meme tokens leading the way. I've said before that I feel like meme tokens are a slap in the face to what was supposed to be a promising decentralized finance just industry, and it just hasn't turned out that way. It seems like meme tokens, ordinals, couple of bright spots in crypto, and that's about it. Lots of last cycle's winners are really not doing so great in terms of token performance this time around. Here are your losers. Of course, I have some Phantom, so this is not really great to see, although Phantom did do all right last week. Akash giving some back here. Akash is in that nice D-pin category where a lot of the real products actually reside. Like I call it Web 2.5. I've heard others refer to it as Web 2.5, but there's no denying that crypto is at or near all-time highs in overall crypto market cap. Bitcoin is still dominating. Most people would expect Bitcoin to give some market cap back, have it bleed into other tokens. That's not what's happening so far, but we are kind of early. The halvening just happened, and yeah, we'll see. We'll see. Maybe in a couple months things will change drastically. That's what crypto is pretty much all about. We're going to go to ETH first. Let's go to ETH first. We are going to talk about tokenomics today. Tokenomics, super important topic for me. I really try to understand tokenomics because I think a lot of the secrets lie in the design of these economies that developers are building or trying to build. We're going to talk about low float, high FDV tokens. Binance put out a report this week about it, and we're going to dive into that just a little bit. Before we go any further, there are two sponsors I have to mention. Kinetics Finance, we're going to talk about them specifically at the end of the stream, and they are a perps DEX and more on the Kava blockchain. That's kind of Cosmos, kind of EVM. It's both, and we'll talk about that at the end because they're making a very smart move in my opinion. And the other sponsor is Shade Protocol, privacy preserving DeFi applications. They have a DEX that's completely front running resistant, and those are my two sponsors. Happy to take them on, and happy they support the channel. All right, so let's try to get this on the screen first of all. It's going to be close enough, as close as I can get it. So, big news last week. SEC approves the spot ETH ETFs. And obviously this created a surge in token price for most ERC20 tokens, including especially Ethereum. I saw at one point ETH was up like, 28% in one day. Pretty wild for a big market cap token. There's a misconception that the big market cap tokens can't move as much as the small market cap tokens. That is not true. And and this is the announcement right here. The US Securities and Exchange Commission actually does approve the first batch. I think there's 9 of them. Spot Ethereum ETFs. And it goes on to say these ETFs could have huge implications across financial markets. You think? Ethereum is definitely the second most popular cryptocurrency, and there was speculation that this would never happen. Right? Gary Gensler is saying it's a security. Almost all cryptos are securities, not all, but almost all. Well, whether it is or it isn't, maybe cryptos are going to be hard to put in one bucket or the other. But long story short, investors now can get direct exposure to ETH. They don't need to purchase it themselves. They don't need to store it themselves. This is huge. A lot of people are not going to trust centralized exchanges. A lot of people are not savvy enough to custody their own tokens. ETF is a natural choice. And whether people think ETFs are good or whether they think they're bad for crypto, I tend to think that it really doesn't matter, because not everyone is going to enter crypto the same way. Not everyone's going to go to a Bitcoin ATM. Now that people can access these in their retirement accounts, on their brokerage accounts, Fidelity, whatever, we've got them. So it's part of the industry now. Or I should say, crypto is part of the traditional finance industry now. Got F Crypto Pepper in the audience. Thanks for joining, man. Almost everyone I could see on my analytics is joining me on Twitter. It's very interesting because I thought YouTube was the place to be, but man, oh man, a lot of people join from Twitter. A lot. And this goes on to say, it's been a long debate on whether Ethereum should be deemed a security or a commodity. Critics claim it passes the Howey test. Therefore, it should be classified as a security. And there are 4 parts of the Howey test. We talked about it on a previous stream, but just to review, it's an investment of money. There's expectation of profits, a common enterprise, and reliance on the efforts of others. So Gary Gensler interprets this very loosely. He basically says, like, if there's a company developing software attached to this cryptocurrency network, it's a security, because it's a common enterprise, expectation of profits, reliance on the effort of others, and it's an investment of money because people are buying these, right? So that's kind of a loose interpretation. I'm not a finance expert, but if the United States government is going to interpret these very loosely, I think Michael Saylor, who said only Bitcoin would have a spot ETF, he was actually on the right track. And then there was this massive pivot the last 2 years, probably because Trump and other prominent politicians are now talking about crypto, right? They're talking about crypto. Whether you think it's good or bad, I tend to think that sped this along. I thought the ETH ETF would take a very long time. Initially, it would be rejected, and then eventually it would play out that it would eventually become at least part of a spot ETF. But it's happened quick, and I think Trump kind of, with his rhetoric, made this into a political issue sooner than most would have liked to see. That's my opinion. And this was back in, so this is a video, I'm not going to play it, but I'll put links in the description as usual. This is a video from 2014. I think this is from when he's teaching at MIT. I could be wrong. Maybe that MIT class was later than this, but he explains why he believed at the time ETH passes the Howey test. So, there's been lots of developments, both regulatory and with the tech. So I think that the ETH 2.0 probably was involved in changing the status a little bit in the minds of some for ETH. I happen to think, I have some fringe beliefs on Ethereum. We could talk about that, but I tend to think that the gas fees, I think the gas fees on Ethereum are actually not a problem. It's an indication that the block space is super valuable in these high congestion times. The gas prices go up $100, $200, whatever, $300 for transactions, especially smart contract transactions. And man, maybe ETH block space is a commodity, but the token is a security. I don't know. But ETH's block space is more valuable than any other blockchain's block space. It's really hard to argue that. Block space refers to basically how many transactions can be verified or approved in a certain amount of time or space on the Ethereum ledger. It's a really simple way to think of it. But here's another article here talking about how Gary Gensler didn't vote for them. So the process for Ethereum's spot ETFs was a little bit different than the Bitcoin ones. It says Bitcoin's ETFs were approved by a five-member committee, including Gary Gensler. But the spot ETH ETFs were approved by the Trading and Markets Division of the SEC. In Web3 terms, if the SEC is a DAO, the Trading and Markets Division is a sub-DAO. All right. So different process. Maybe that helped it along. Maybe that helped Gary Gensler stay kind of on the sideline and not have to admit that this was a fair process and that the ETH ETF should be approved. He could maintain that position like, no, everything's a security, because I like to interpret the Howey test as loosely as possible. I don't know. But the bottom line is, it is tradable and obtainable as an ETF. And here they are. Here are the different ones. Let's see if I can get this on the screen finally. Let's see. But we got 9, right? And there are others too coming. These down here, no ticker yet, but there are some other spot futures. So slightly different, all involve ETH. And this article I'll link down below. Interesting article. And again, why can't I fit this? There we go. Man, oh man, it's so hard to fit these websites onto the shared screen here. Let's see. That was too big. I can't even fit one word. Anyway. Oh, there we go. So this is saying, this is the block. The SEC's approval of Ethereum ETFs still leaves some questions on whether ETH is a security. Lawyers say they're going to fight about this for a while. I would imagine every cryptocurrency has its different nuance of how it works, where the value of the currency actually comes from. With Ethereum, I think it's kind of straightforward. The ETH token derives its value based on how valuable the block space is over a given period of time. Now that we know gas fees can be up into the hundreds, that really, I think, caused the block space to become actually scarce in certain periods of time, actually become a commodity. The redesign of the tokenomics for ETH created some deflation to offset the inflation. And now we're looking at, ETH between $3,000 and $4,000 a token. When I first came into crypto, I think ETH was like maybe $180. I did buy it in the last bear market around 150, but I only bought one token. So ETH has been really volatile for its high market cap. So this is saying whether or not the SEC actually has jurisdiction over ETH has been a little hazy. Legal sources have differing views on whether the SEC's approval means anything has changed. So is it a commodity now? Still unclear. I don't think it matters. If it's an ETF, it's an ETF. Who cares if it's a commodity or not? Curious what some of you guys who maybe have more TradFi knowledge than I do, if you could shed some light on this, I'd be happy to respond. You could shoot it into the chat, or if you're watching this on the replay, throw it in the comments or shoot me an email. Cosmos DeFi is my Twitter handle. It's also my Gmail account. I respond to everybody who emails me, and I try to respond to everyone who comments down below. Let's go to tokenomics. All right. All right. So. Binance, and I don't have it ready for you, but Binance put out a paper on predatory tokenomics, or what could be construed as predatory tokenomics. In other words, it might benefit the people issuing the token a lot more than it benefits the people that are buying it, even if you get in kind of early. And these this predatory tokenomics model is being referred to as a low float, high FDV model. Well, I'll explain what all that means. But I spend a lot of my time looking at tokens in the Cosmos ecosystem, not only Cosmos, but mostly over there. And I have seen a trend in this direction. I mean, projects that launched, especially 6 months to a year ago, 6 months to 18 months ago, they went with this model. And we'll look at it somewhat objectively. I could kind of explain, if you don't know what I'm talking about, why this is crucial. But it looks like this allows insiders to sell tokens before their vesting schedules actually end. We'll talk about that. And it really causes the price to peak probably sooner than it ordinarily would have, because you have this like really temporary supply squeeze and the expectation that there are vesting schedules for insiders, VCs, founding team members. Well, that's just not the case. So let's take a look. Let's try to get it on the screen as usual. All right, so this is Binance research. Low float and high FDV. How did we get here? And there's a full report you could download here. But basically, they're saying a lot of people in the crypto community are discussing these high valuation tokens with an initial low circulating supply. That's the low float. That's the tokens available to be traded. And they cite data from CoinMarketCap and Token Unlocks. And it's an analytics site. And it can confirm there is a growing trend of tokens. And I pay attention mostly to Cosmos. I've noticed this as well, whether it's Celestia, Dimension, Saga, Archway, we'll look at as well. And this, you could track the unlocks for these different token supplies. Most teams, they put out their tokenomics in the white paper. It's a little hard to decipher. The model they put out is really only good the first day, and then the tokens are changing hands slowly over time. But yeah, it's basically saying that there are some really aggressive valuations and some positive market sentiment, and this has accelerated this trend, this high FDV, which is fully diluted valuation. This is the valuation of the token, the market cap, if all the tokens were in circulation, and they're usually not. So they conclude here, say VCs, they play an important role in our industry and can work together with project teams to ensure equitable supply distributions and reasonable valuations. Well, they found a way to not do this and benefit themselves. Just when I was warming up to VCs, now I'm seeing how they do things. And let's look at Celestia as my example here. And why can't this fit on the screen the way it normally does? This is going to drive me crazy here. Give me a sec, guys. Why can't I? There we go. Let's see. This is the most annoying part of the stream. I should just screenshot all this and format it ahead of time. I bet some people do that. Like, there's no reason why this can't fit on my screen right now. It always does. It always does. So I might have to do something different here. We'll do this. So all I want to say about Celestia is this was a highly anticipated token launch. It's part of the Cosmos ecosystem, but the utility of Celestia should extend far beyond Cosmos. You could think of it as an infrastructure blockchain with a token. Man, they basically created and rode the narrative of modularity for probably like all of 2023. And they launched a token in fall of 2023. So this is cryptorank.io, and I can get some information about the token here. I want to look at the overview. So they give you the general overview. Here's the chart, and you can see. Let's go weekly. Got off to a great start, right? They airdropped a bunch of their tokens. Sometimes with airdrops, there's an initial dump, and there was for like a couple days, and then it basically did a 10x, 8 to 10x, and has sold off 50%. All the while, Bitcoin's hitting all-time highs, right? So it's tough because it's not tracking as many alts are finding. It's not easy to track the crypto markets at all. But what's interesting about Celestia is that, yeah, it went to $20, but some of the early investors, the early backers, they got in really cheap. They got in, some of them at a penny, right? So they're up almost 1,000% even after this 50% dip. But the problem is their tokens are supposed to be locked in vesting contracts, so they don't have access to the tokens right away. Actually, not that many tokens were in circulation right away. It was like 20% or less or something like that, even with the airdrop. So this would qualify as one of those low float, high FDV tokens because the valuation was in the billions or in the hundreds of millions at least. Here you could look at vesting. And blue is unlocked. The 16.8%, this green is what's next to unlock. And then the rest of it is locked for beyond that time. There's 4 rounds of unlocks. 16.8% of the total supply is set to be unlocked October 31st. All right. And these locked tokens are people who invested early and helped get the protocol off the ground, funded development early on. These were not public, right? This is the 1-year cliff. So the token must have launched October 31st of 2023. And those tokens that were bought at these really cheap prices are supposed to be locked for a year. And if you're buying TIA token, you might say, this is great. I get to buy and sell my token when the insiders can't. Well, it's not entirely true because they're able to use their tokens to take advantage of inflationary rewards like staking, possibly LPing. And I'm not picking on Celestia here. I'm using Celestia as an example. In general, the problem here is even with these vesting schedules, which are tough, right? You invest all this money, you wait, then the token launches. You got to wait a year, 2 years, 3 years to be able to recoup your initial investment. Well, with these new deals, the investors are able to farm. They're able to farm, and they can make back way more than their initial investment before the vesting unlocks happen. And it's not fair. It defeats the purpose of the vesting schedule, right? So let's go back to fundraising. And I'm not picking on Celestia. They're just a great example because if I'm able to get in at a penny, I don't even care about the price action. If I'm able to stake this token and earn the 10, 12, 15% APY, which if the price of the token was still a penny, it would be not such a great investment. I'd have to really be hoping by the end of my unlocks, the token has gone up. And I took substantial risk, so I'm expecting substantial upside. But if the token is $10 and I'm up 100x, I don't have to stake the token that long to recoup my initial investment, right? And I don't have example in front of me, but it's basically 100 times faster, right? So if it would take me, let's just throw numbers out the window. Let's say if the token price stayed the same, it takes me 5 years just by staking to recoup my staked amount, a return on my staked amount. Well, if the price goes up 100x, I don't even care about my initial amount. I want to farm while I can, while the prices are high. As a VC, early investor, even founding team member, by the time all my tokens unlock, I don't have to even sell it. And I made a fortune. Meanwhile, everyone else that didn't participate in these early seed rounds, they're buying at a high valuation, a really high valuation. So that's Celestia, but this applies to lots of other tokens. Let's look at Dimension. And I know I can get this on the screen to show you where to look. So if you're researching tokens and you're like, oh, I'm worried about tokenomics that could be considered somewhat predatory, well, look no further than Dimension. So it's a new token that launched. It went up initially, like Celestia did, but in very short order, it's gone down. And that's because those that got in early with Dimension, from what I understand, were not only able to farm, they're able to sell. So whatever the valuation is, let's assume it was way lower. than the price when it hit the open market, $4.70. If I got in at 40 cents, I'm up 10x. I might be selling a bunch of it here. So as an early investor, how much value am I actually bringing to this token if the design is like this? As an early investor, VC, founding team member, seed round investor, whoever you want to point a finger at, I took on a lot of risk waiting for this to launch. I got to make some money back, but this almost kills the token out of the gate. Let me show you how to figure out the float. So the market cap, this is how CoinGecko works. The market cap of the token is the current price multiplied by the circulating supply. And I know there might be different definitions for circulating supply. I would consider circulating supply to be any tokens that are not locked in some kind of vesting contract. Okay? Basically what's tradable on the market right now. And the fully diluted valuation is always higher than the market cap because this takes into account all the tokens, the total supply. And what's the total supply? The total supply is any supply that has ever been set programmatically to be minted minus whatever was burned, right? So it's like the max supply is the coded supply, the coded max supply, like with Bitcoin, right? It's like 21 million whatever tokens. That's the max supply. But if someone burns a whole bunch of Bitcoin, let's say a million gets burned, the total supply can only ever be 20 million. So total supply is usually going to be a little less than max supply. But anyway, the market cap's based on the circulating supply. Those are the available tokens to be traded. And then FDV, this is the total valuation as if all the tokens were in circulation. You could see this is almost 10 times higher, right? It's 8 times higher. 10 times higher, almost, right? And that's because these teams aggressively value the project while also only releasing a small amount of tokens at the onset of the launch. This creates kind of a perfect storm for price action, which is what everybody wants, but it's very temporary. And what I mean by price action, there's a supply squeeze right out of the gate at the exact moment that hype is at its peak. The launch of a token is the peak of interest, anticipation, and of course, marketing. So you get this supply squeeze. People are buying because they either could not participate in these early investment rounds, did not get an airdrop, right? So they're late. And they're actually really late, even if they're buying the first day the token's available on a DEX. So again, not picking on Celestia, not picking on Dimension. These are just perfect examples for what I wanted to talk about today. Here's SWI, same thing. You can see price action actually dipped out of the gate, right? It launched around this time last year. So obviously the summer was brutal for altcoins. So it sold off, spiked, and now we're having this other massive dip. So let's look at the float here. Well, market cap is 2.5 billion. That's the value of the tokens in the circulating supply, but the FDV is almost 11 billion. That means only about 25% of the supply is in circulation right now. Wow. So, and I wonder what it was early on. Maybe it was half that early on, right? I don't know what their inflation schedule was like, but not that many tokens were available. Archway. Here's an interesting one because Archway, I don't think the numbers are reported properly. This has the circulating supply at 300 million, giving it a market cap of 31 million. It's about 10 cents per token. Nice, easy numbers here. FDV is 107 million. So basically about 30 to 35% of the tokens for Archway are in circulation, but that's not really true because some of these are vesting still. And the numbers that I was able to pull off another analytics website token track shows this. And let's get into a better configuration here for the home audience. Shows this. So what is this? Well, this is like a linear expression of where the tokens were initially allocated at Genesis and when they will be available to be sold. This doesn't mean they're going to be sold. They're available to be sold. Archway is of interest of me because I hold a whole bunch of AXV tokens, which is a DeFi token on the Archway chain. So I don't want Archway to perform badly, obviously. But in the beginning, the Genesis event was July 21st. Token went live. Very low float. About 50 million tokens were available out of the 500 million max supply, total supply. That's only 10%. It's only 10% available. But because of inflation, staking rewards, bootstrapping liquidity, right? At the end of the first 12 months of its life cycle, the Archway Layer 1 token, Arch token, the supply will double. That's reasonable when it's the first year and you have to get tokens into circulation. What happens here? The supply balloons after this. So from this July to January, we go from 100 million circulating supply to 200 million. So it's going to double again. That's 4x in a year and a half. And then in the next year, it doubles again. So with all these unlocks, people who bought early and had to wait, and I don't know if Archway early backers, founding team members, and early investors are able to sell able to farm with their tokens. That I don't know. But this is of interest if you hold the token, because you're holding the token when there's basically a supply squeeze here. And then over the next year to 2 years, there is no longer a supply squeeze. And you might be thinking, so what? Well, that directly affects the price because inflation dilutes the value of the tokens that are already in circulation. And I'll give you a great example. This is the graph. So why am I showing you the graph? This is not a new token. No, it's not. This is about 3.5 years old, this token. And we could ignore all this price action because the market conditions were different. And then there's this long lull. And then we get a little life here. I actually bought somewhere over here. So I'm interested in this token. That's one of the reasons why I wanted to use it. I knew that this would be a good example for what I want to show you. So I'm looking at the price. Peak price was February 12th, 2021. What happened after that? Well, that was a low float token. Look how low the market cap was. Even with a high price, the overall market cap was low because the circulating supply was low. Peak market cap was here, November 6th, 2021. Well, the price must have been really high here if the market cap was high. Market cap is the total value of the tokens in circulation. But let's look at the price. No, the price had already sold off more than, roughly 50% from the highs. But how's that possible if the market cap is high? How's that possible? It's possible because of the way the inflation schedules work. Emitting more tokens into the ecosystem dilutes what's already there. And you could think of it as an expense to the network. You can, although the graph is not its own network, but people need to be aware of where the selling of the token can come from. And a lot of times it's just coming from the inflation, staking rewards, LP rewards, airdrops, unlocks, which is what we just looked at with Celestia and Archway. There are unlocks happening. Causes the supply to balloon. What happens to the tokens that you're holding? They get diluted. How do I not get diluted? Well, either you have to be a beneficiary of that inflation or the new unlocks to accumulate more tokens, or you have to buy them, or you have to sell before this happens. Boom. Look at this. From about $2.50 down to 50 cents. That's an epic implosion here. It's an epic implosion. And this is not even a bear market. The market, the inflation schedule, whatever it was, vesting schedule for the graph. I'm not familiar with what it was. I bought all the way over here. I bought about 6 months ago. I had no idea what the graph was until 6 months ago. But inflation is probably what killed this token price. Maybe some news, maybe there was a protocol hack, whatever. But really it's the inflation, because the value kept going up as the price is going down. And that's all I wanted to show you, to make the point that these low float, high FDV tokens, they might be predatory. They might be the best way to get tokens into the ecosystem for some. It's definitely not the best way for tokens to get into the ecosystem if you're buying it over here, not even at the peak valuation, but buying when there's a supply squeeze, and then the supply explodes over the next 6 to 12 months and you get diluted if you're not accumulating more tokens. So Binance, I'm going to keep following, see if Binance keeps it up. I see a lot of these on Binance Smart Chain. So it's interesting that Binance put out this report, because I think that that's the place where I first became aware of these. I'm looking at these DeFi tokens on Binance, and what do I see? Only 14% of the supply is in circulation. I'm not going to buy that. I'm worried about where the rest of the supply is going to come from, when it's going to come, and how much at one time. All right. Let's go to our last little phase here. We're going to talk about AI and crypto. We're going to talk about AI and crypto. So, man, oh man, I can't get anything to fit on the screen today. There we go. Tweets still fit. Got a little greedy there. So, we're going to talk about AI and crypto. I think we're early for AI integrations into crypto, but that doesn't matter here. Here's my tweet. One of my tweets. Analyze your portfolio. Which of your tokens are capturing the tailwinds from major crypto narratives, such as ordinals, AI, DPIN? Add memes to that list. These are already winning. Tokens that are not positioned to benefit from these narratives will disappoint. And I still believe that. This is from March 7th. In other words, you buy a token. What's the team doing to increase the value of that token? Are they trying to integrate AI? Are they trying to partner with DPIN products? Do they have any overlap with ordinals, meme tokens, anything that's performing well in this market? Well, if not, I think these are really going to struggle to outperform their previous all-time highs. And here, I'll double down. This is March 8th. I must have had a good week that week. I was feeling good, commenting on my own tweets. If a founder is not trying to tie their project to a major bullish narrative, the token will be outperformed by inferior ones that do. If the founding team is issuing a token, they're selling it, they're implying that it has value. And if they're building around that token, they're implying that what they build should add value to that token. In very rare circumstances, is that not the case? It's implied. If they don't try everything they can to latch on to one of these narratives, I consider these to be the big three, and I will gladly throw in AI there. They are failing as founders. Unless they have some major breakthrough and great marketing, they don't need to attach themselves to these narratives. Fine. How many projects are actually in that category? Maybe 1 out of 20, 1 out of 50, 1 out of 1,000. I don't know. But I still think this is true. Why am I bringing this up? Let's look at Kinetics. Kinetics announced recently that they will have AI integrations, and I'm really happy they're doing this. They sponsor the channel. They sponsor the channel. At some point when they launch their token, I hope I get some of those tokens, right? They're going the route of AI. They have smart builders on this team. They have smart builders. They built the number one DEX on Polygon the last bull cycle. Doc's team. Building on Kava, which should be a stable coin liquidity hub. They have a partnership with Tether for native USDT. I love this. The Kinetics ecosystem where DeFi meets AI. And I said before, I think we're a little early for AI to have a meaningful impact on crypto. I could be wrong. I think we're kind of early though, but it doesn't matter. What can we do with AI? Well, maybe we could assist, make the platform experience better, especially for new people. I used this platform a couple of times to do some leverage longs. And I think I had 2 good ones and 2 bad ones, and then I took a break. But look, AI powered platform experience, learn about the platform, check asset and leverage availability, and even execute trades. Simple prompts. Execute trades from simple prompts and queries. There's your AI companion right there. Most of these DeFi websites, if you don't already know how to use it when you get to the website, you have no chance whatsoever to figure it out. Kinetics is going to leverage AI to help people get the most out of the platform experience. I'm not saying perps are for everybody. That's not what I'm saying. What I'm saying is they are now able to say, look, we're an AI DeFi platform. So much better than marketing. Oh, we're another perps DEX. Big deal. There's like a million of them. What's good about Kinetics? Oh, I got this AI enhanced experience. I could type some prompts and the platform's going to kind of tell me how to do what I want to do. What else? High performance trading bots, optimize trade execution, protect against MEV. I mean, they're going to be able to claim that they're one of the only AI enhanced DeFi platforms. This is great. This is great for a business. This is almost like a pizzeria in a town full of pizzerias able to say, oh, look, we're the only pizzeria where someone from the Food Network came and gave us this plaque on the wall. We're the only ones. Kinetics is in this position now because they're aggressive and they know which way the wind is blowing. If your founders of your tokens don't know which way the wind is blowing, you're going to have a rough bull market because you're going to watch your token underperform even itself in the last bull market, probably. Strategy Hub. I like the sound of that. I go to a platform and I'm kind of feeling my way around. I see Strategy Hub. I'm clicking on that. Hey, I need a strategy. I'm trading with real money. It's kind of gambling. Help me, AI. What does it say? Enlist cutting edge AI services to execute sophisticated trading strategies on your behalf, all in a single click. Beginner, intermediate, expert. The AI can meet the users where they're at, right? From simple prompting to executing actual trades. I think this is tremendous for Kinetics. I'm really, when I'm in a Telegram, obviously, with people from Kinetics. And by the way, they put on outstanding spaces every other week, awesome spaces where they include lots of other founders and builders. They don't only talk about their own project. They keep the conversation going. This is why they know what's hot and what's not in crypto. AI. Can you integrate AI into your platform any way possible? No. How about DPIN? Can we partner with DPIN? No. Do we have any leg up on memes in our ecosystem? No. Then what are you doing? Why should anyone buy your token? Why? It's unbelievable. If you think you're going to buy a token and it's going to just do what it did last time because that's what your token does. No, you got to latch on to these winning narratives, and every cycle is different. Last narrative was metaverse. Where's metaverse now? It's nowhere. Maybe AI will be nowhere in 4 years. Doesn't matter. Right now, it's here. And yeah, kinetics, killing it. So, I think I'm going to wrap this up. Yeah, I think I'm going to wrap this up. I hit everything I wanted to hit. Went a little longer than expected, but we'll fix that. We'll streamline this down a little bit. We talked about the Ethereum ETF, little Gary Gensler, and maybe disappointing to him, and also Michael Saylor. He was wrong, but you know what? He took it all in and kind of changed his position with the new info. Obviously, there was some politics behind this, right? We got educated on these low float, high FDV, possibly predatory tokenomic designs. Be careful. Rewatch that part. And if I didn't word something clearly, reach out to me. I'll try to explain it even better the next time. And AI, crypto, why not? It's there. Use it. Founders should be doing this. Even community members should be giving ideas to the founders. Like, if you're buying this token, it's the bull market. All that matters is the price goes up. How it goes up, it's different for every token, but you got to try. You got to put yourself in a position to win. Bull markets are very short. Bear markets are long. They're excruciating. They're painful. And I don't want to go through another one anytime soon with the majority of my portfolio. So anyway, adios. Happy you guys